If I could ask for, we have to do the Pledge of Allegiance, sorry.
Way down there.
Welcome, everybody.
Are you in timeout?
I'm in left field.
Dave was the chair. I took him over by Neil. So.
Oh. Do you want to move?
Dave's over by Neil.
Yeah, I didn't know he was the chair. My apologies.
That's okay.
Oh, which Dave?
It's okay.
Dave Pataski's over there.
Yeah, no,
Wanna-
Dave
Pataski's over there.
Closer?
You've got the right nameplate.
I would.
It's magnetic.
You're okay on your
I can
island.
move it for you.
I could do it. I could do it.
Let's do the Pledge of Allegiance.
To the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right.
Come on down, man. You're okay.
If we could do a roll call of attendance, we'll start with Rana.
You got one of these, right? So you're
I got one, yes.
Present here?
David.
Dave Olson, present.
Danny. Dave Petoskey.
Michael Shostak and Neil.
Neil eventually. be
Neil
here.
Barnett.
things are.
He's doing some housekeeping.
Any public comment? Seeing none, we'll move to approving the minutes from May 2nd, 2024. Can I get a motion?
I move that they're approved.
Second.
Second? Okay. And all in favor?
Aye.
Aye. Any opposed? None opposed, it approves, it passes. Quarterly performance, portfolio review. I know Michael wanted to
Yeah.
take operating reserves.
So I'll just start with a quick summary of the operating funds. So we ended the quarter with a little under $73 million in our operating reserves, which was down meaningfully from March by about $20 million. The key drivers there were the lack of, in the March quarter, we were still collecting taxes and paying that out, and so we had a little float that we had in there. In the June, we of course don't have that. We also started to pay for the large road paving project in the village. That was a big outflow of cash as well. But we're well back at the level today that we were back in March, and that's split again between bank CDs, bond portfolio, mostly treasuries, some agencies, and local government investment pools. Aside from that, we'll move on to the fiduciary directed investments, which are the DB plan, and that's back to the pension plan.
Okay.
Those are just the operating reserves.
I think, Michael, you're going to take that?
Yeah, the investment summary. So Mike Holycross, for those of you who don't remember, when meetings moved to Thursdays, we have another client that meets at 8 a.m. on every other Thursday, so I've missed the last couple. Brian had a previous scheduled engagement, so it worked perfectly. I'm able to pinch hit for him and pass along some of the news, talk about what's going on in the portfolio, and then some updates on the investment side that Brian and Michael Shostak have been talking about behind the scenes and kind of getting ready for maybe we do some of these new investments going forward to further diversify the pension portfolio. So if we look at page one, this is our executive summary of what happened in the month of June and also for the quarter. So again, if we just looked at the S&P 500 line and we went to the year-to-date column of 15.29%, you'd say it's a pretty good year for the equity markets, pretty good year for the capital markets. For the quarter, up 4.28. That's a good quarter, because if you annualize that out over 4 quarters, you're up over 17% for the year. But it's really a tale of two cities. That 4.28%, 5 stocks represented 100% of that return. It's the same as we talked about last year with the Magnificent Seven, these large cap tech growth names that are driving performance. Now it was 5 names instead of 7 that have driven the entire market returns. So now if we break down that S&P 500 and we said now it's the S&P 495, the rest of the index was down 2.78%. Really narrow leadership, which is not a healthy environment in terms of getting broad exposure when we have international stocks, small cap stocks, mid cap stocks, value stocks, right? This part of the portfolio is just not participating like large cap growth stocks have been. And that's relevant in the indices. You see it represented 3 months, so the quarter Mid-cap stocks are down 3%. Small-cap stocks are down 3%. That's represented by the Russell 2000 is the small-cap index. Growth stocks are up 8.3 versus negative 2.17 for value stocks. So if you weren't invested at a heavy clip in things like Apple, NVIDIA, Microsoft, where they're 13% weights, 12 to 13% weights in the Russell 1000 growth, which is pretty aggressive, you're going to underperform those benchmarks. And you can see it in the growth for the year, up almost 21% versus value up 6.6%. So while the overall returns seem healthy, good, it's really, you'd have to take excessive risk in your equity portfolio. Think about it, your top 3 names have to be Apple, Microsoft, NVIDIA at almost a 30 to 40% weighting in 3 names. I don't know that anyone would want that kind of concentration risk in their individual portfolio, and we certainly don't have it here. So we're going to see some of these strategies where we have the index fund, great, but we have it diversified with some other active managers, and you're going to see some underperformance. On the fixed income side, the month of April, we've seen rate volatility for almost 2 years now. April, the market was still coming to the realization that we're not going to have 6 rate cuts this year, and so rates skyrocketed, right? And then May, they kind of stabilized. June, they started to come back down. So when rates go up, prices on bonds go down, we see negative returns. So for the quarter, if you just looked at it, you said 0.07%, not a lot happened. Rates moved pretty aggressively. The 2-year Treasury in the second quarter, in the middle of April, went above 5%. It's now at 4.35%. It finished the quarter at 4.75%. So you can see move back in June quite a bit, and then even more so in July. The market getting more comfortable, especially even yesterday, rates came back to us after Chairman Powell spoke, that the market coming to the realization, okay, 1 or 2 rate hikes certainly is possible this year, first one in September. As long as we still get inflation stabilizing, if not ticking down from here. But what I think what we're starting to see for the very first time is the labor market, while has been very stable, probably starting to slow down just a little bit. And the Fed typically, historically, right, is always a little bit late to the game, which we saw in this cycle. That's why they had to do the fastest, most aggressive rate hiking cycle in the history of the Fed. And they're a little bit late after the game, right? They already see potential signs of recession on the horizon, and they start to lower rates at that point. So, yeah, we agree that a September rate cut is largely baked in by the markets. 1 rate cut, 25 basis points, and then they probably won't go again until the end of the year. They do not want to get they don't want to impact anything that's going to happen in November in the general elections. And you can see on a year-to-date basis, because of this rate volatility on that U.S. aggregate bond index is still in negative territory, negative 71 basis points. With your portfolio, having exposure, well, actually your fixed income, that's on RHC. And if you look at year-to-date sector returns on the bottom left there, so it's no surprise by those comments about what's driving the market in terms of returns. Information technology, best performer. Communication services, second best performer. And then everything else in the S&P 500 has underperformed the average return. So you got 2 sectors, 5 names, 6 names that are driving returns in the S&P 500. That's changed in July. Obviously, it's not going to be reflected in this report. Rates have come back aggressively. Small caps have had one of the largest relative rallies to large cap stocks, about 15% in the month of, they've outperformed large cap stocks. Small caps have outperformed large cap stocks. We talked about this in RHC, so my apologies for Michael for already hearing this anecdote. Many folks historically would say, okay, small cap stocks are rallying. The market's telling us we see green pastures on the horizon, good economic times. Small caps are typically going to lead out of that rally. I don't think that's the case this time. I think the market is saying we see rates ticking down over the next 18 months. Small cap stocks are generally more debt laden, it's variable rate, as opposed to large cap companies which have much more access and flexibility in how they're going to get to the capital markets to raise debt. They could float bonds, they could do a lot of different things. They have a lot more fixed rate debt. So the cost of capital, while still impactful for balance sheets for large cap companies, is way more impactful for small cap stocks. So if we think we're going to have lower rates in 12 months, 24 months, it's a bigger benefit to small cap stocks and the health of their balance sheet. We don't know necessarily that it's the start of a greater economic cycle, which would typically indicate a large cap or small cap rally. For instance, compare that historically when we came out of the great financial crisis. In 2009, the best performing stocks were debt-laden small cap companies that were unprofitable. We called it the rise of the Phoenix stocks. And small cap stocks kind of led us out of the rally for the next 12 months, much greater than large cap before large cap kind of took over and started to outperform, particularly growth companies. We don't know that it's that indicative for this part of the economic rally. Let's look at some of the performance. So this is page 3 of the hard copy. Couple just high-level observations. You know, the decision to have active and passive, certainly the passive has helped because we're getting broad representation, even in the S&P 500. In the last year, up 24.56%. Concentration in those 5 to 7 names has helped. So you have large cap S&P 500. You have the Fidelity Extended Market Index, which measures small and mid cap stocks. And then the same on the international side, the International Index Fund, which is the EFA blended with the Oakmark strategy. So that has helped. Diversification within the small and mid-cap side. So your committee added the Reinhardt Partners Genesis PMV, which is a small mid-cap portfolio, in the beginning of this year, 2024, to offset some of the Clarkson portfolio. So that has helped. And even though Edgewood has underperformed in the last year, and that 3-year number is a little difficult to digest because that 2022 underperformance still lives in that 3-year number. They've competed and done better than the Russell or the S&P 500, and it's just a simple decision of those 5 to 7 names: Apple, NVIDIA, Microsoft. They'll hold 0 Apple, so they would have underperformed because of that. NVIDIA, while they've taken profits, anytime it gets to an 8% weighting in the portfolio, it's mandatory risk control that it has to be trimmed. So they've been taking profits from that stock for 2 to 3 years. This last quarter, they actually trimmed it to a 5% position. So they took almost half of the exposure to that stock off the table, just to take some profits off the table. They will have underperformed because you've got a 5% weight versus a 13% weight in the Russell 1000 Growth.
Mike, can you just go over what you had discussed at the previous meeting with Edgewood, the long-term history for anyone who did not?
Yeah, so
hear it?
it's a good, and they're fair questions. All clients are asking these questions wherever, if they see Edgewood and Clarkson in their portfolio. Brian and I have the benefit of working with these firms for potentially 20 years. Not that we fall in love with them. If they have to be terminated, they have to be terminated. But Edgewood we know very well. Since the inception of that firm, their rolling 5-year batting average is outperforming their benchmark and their peers is well over 90%. So very consistent. And they take their risk controls. It's only a 22 stock portfolio. So things like Netflix. 2 years ago, Netflix was a company that was thrown to the side and taken out to the woodshed and beaten pretty good because the market was trying to get their arms around what does this ad platform look like and how is it going to impact revenue for the broader user base, which had been around for almost 20 years. I don't even know what I pay for Netflix, but I know I paid for it because I signed up for it 15 years ago. And I know it just continues to go up. So anytime a stock misses for 2 or 3 quarters in a row on expectations or is down by a certain percent, it gets re-underwritten by a new portfolio manager and a new research analyst. And that portfolio manager that sponsored it originally cannot vote So unanimous decision going into the portfolio, 6-0. It only takes a mandatory. You now have the portfolio manager that's sponsored not being able to vote. So a 3-2 vote to exclude or continue to include on that stock if it was to sell or stay in the portfolio. So that stock was reassigned, and it was decided to keep it in the portfolio. It's been one of the better performing stocks for the last 2 years once they underwrote that portfolio. So long-term results for them, again, our apologies because you don't have the perspective. It goes back to 2020 in your portfolio. If we showed you the composite, and I think Brian did this last year because of the 2022 underperformance, he showed there was a graphic that showed rolling 5-year performance to the Russell 1000 growth, and you had over 90% to the upside and fewer observations to the downside. So they've been very, very consistent. But because of 2022 and then 23 and the beginning of 24 with a heavy concentration in those 5 or 7 names, they've underperformed. So they've chosen actively to keep a significant underweight relative to those stocks in the Russell 1000 growth, which are almost 35, 40% weights in Apple, Microsoft, NVIDIA. And they hold a 5% in NVIDIA. Microsoft is probably also a 5%, if not lower, because it's in bucket 1. So 10% versus almost 40% weight in the portfolio. And that's just an active decision. It's a risk control decision. But when 5 stocks are driving returns in the S&P 500 or the Russell 1000 growth and nothing else is performing as well, they're going to underperform in this environment. Yes, sir.
But, I've got the question more on Clarkston. We've gone through this
Yes.
a year ago and
Yeah.
then a couple of years ago, I guess.
Yeah.
We've gone through. But, and I understand that there's still some potential there, but wouldn't we be better off getting just something like a total stock index or something?
We do have an equal weighting on the small mid-cap stocks to your active strategies and then your index fund. So it's about a 50-50 weighting, and it's the same on your large cap exposure.
And the question is should we be looking at increasing the index a little bit on some of those and maybe replacing Clarkston?
Again, absolute fair questions. You look at a 1-year number here, and you think, how can they?
And because we've been through, I know that there is you know
each year.
a lot of solid performance before, but we've had the last year or two.
2021 was an underperformer because we had this growth momentum market. They're just not going to participate. And an investor's memory is about 18 months. You just think about behavioral science, behavioral economics. And so we tend to forget what happened in 2022. So the markets were down about 22%. They were 0. So they were significantly protecting you in down markets. It's exactly what we expect out of them. If they did not provide that in 2022, it would have been an easy decision to make a decision to move on. Because that means something has changed in their strategy, in their philosophy. This is a difficult market for them to participate in. I'd like to see a little better performance, but because of the amount of turnover they've had since 2022, they had 5 or 6 names that were acquired in 2022, which means they're doing something correctly because either private equity or larger companies want to buy these stocks. And so they acquire them, either take them private or merge them into a bigger entity. And so they're buying good names, but the names they tend to add, if you think about them being a deeper value manager, they're not going to participate in these growth momentum markets. There's probably a reason they're value stocks. And what's happened with it, 2 of their biggest weightings that have hurt their portfolio, Clarivate and Leslie's Pool Supply, the growth, earnings growth power hasn't come back as fast, and the companies have had to reinvest more resources, and so earnings have kind of remained lack of robust earnings growth, and so the stocks have been punished because of that.
Wouldn't we be, though, if we adjust a little bit the percentage in active versus the index and just got a total stock index or something and replaced it? I mean, it seems like that we would not be, for most periods, we would probably be in a pretty good position. I haven't been, delved into it, but from my recollection, we would have been in a pretty good position, and without the risk of, the index stocks are, lower cost, and you don't have the risk of
That's true.
having to do that.
Absolutely. On the S&P 500, Index fund, 1.5 basis points. You're exactly right. And you're no different than a lot of other clients that are looking at this underperformance and saying, how long do we wait? We're still very comfortable with the team because we've known them for that long. The
Clouding judgment?
What's that?
Could that be clouding judgment, meaning that I do agree with him that
Oh,
every
oh,
year
this-
it has been the discussion.
No, because our responsibility is to our clients first and foremost. If we think they're picking stocks that don't make a lot of sense to be Clarkson stocks, it's easy decision to move on. So we've seen periods like this where Clarkson specializes in why we think it helps in broader portfolios. Upside, downside capture, they capture about 60% to the downside. So much like we saw the benefit in 2022, these indexes and these market returns aren't going to continue at 20% per annum every single year, right? We know we have to expect some volatility. And are we closer to the beginning of the next great economic expansion or an economic slowdown? I would say the latter. You're seeing cracks in the consumer. You're seeing a slowdown in the labor markets. The Fed has to start cutting rates to get ahead of this. And so we think there has to be more volatility around market returns than 20% returns for the next 5 to 10 years.
One of the things that concerns me with Clarkson, and I have discussed this with Brian, is that in the pension portfolio, we have a specially managed fund. So they trade stocks on our behalf in our account, but they're holding 12% of the portfolio in cash.
Yeah.
And while right now we're earning 5.2 to 5.3% on that cash, as rates come down, that's going to get less and less. And why are we paying them to hold cash?
It's been a consistent part of their investment philosophy. If valuations, and I think we can all argue and hopefully agree that valuations in today's marketplace are probably a little bit stretched, even though a company like NVIDIA can grow its way out of its PE valuation right now just because of the earnings growth power. Clarkson's cash will tend to go up in market environments like this where valuations are extremely stretched. They're just not going to buy these expensive companies. They just refuse to do it. Now, one thing you could do is just sweep that cash if you wanted to redeploy it somewhere else. That's always your prerogative. And they may sell some things in the meantime to raise more cash because they do have a model that they're gonna keep to. But that's always an option for clients to do that. So it's not uncommon. We are used to seeing cash at elevated levels when market valuations are stretched.
And just for the committee's consideration, by contrast, Ancora is holding 6.5% in cash, and Reinhardt is holding under 3%.
Typical for Reinhardt to be more fully invested, yes.
Yeah.
And the Ancora could be more of a interim because they did sell CVS, which was an underperformer in them for the last 18 months.
Good question.
Sure.
So, again, you all are investment professionals, you know this more. So what it sounds like from my perspective is in a great year, that's not their world, and they sometimes underperform, but in a bad year, we can break even. I haven't heard when they're gonna help us to, so that's why
In 2022, they outperformed by 20%.
So we broke even though. They didn't make, you said that they held us at zero. So you didn't-
That's a good
I
year.
understand
That's
that.
a very
What
good
did
year.
the index do
underst-
at that point?
Down 22.
So
If we
on
read
the
about
bad
index,
years,
So
that you suggest,
$100
we
went to
lost
$78. Your $100 with them stayed at 100.
and in the last decade, how many were those kind of outlier years of a 2022 versus a regular year?
They've outperformed in every down market in the last 10 years.
How many
Their
of them?
downside protection is about 60%, meaning if the markets go down 100%, let's say it's 5 to 10 different downdrafts, they've been down 60%. So they don't have to work nearly as hard to the upside. And so when we do see these markets that are really kind of overstretched in terms of valuation, because it's 5 growth names and they're very expensive. Is Apple a good buy at this point? Is NVIDIA a good buy at this point? it's kind of hard to justify from a valuation standpoint, even though you may love the growth story. This is not the market we expect them to outperform. We want better performance out of them, for sure, but we know they're going to protect us in the downside. They've been that consistent since the inception of the firm.
And those 60%, if you were to do like annually, 2022 annually was just a bad year and they were great, in the last 10 years, how many of those horrible 2022 years were there?
Last 20, I mean, you've probably had downdrafts easily 6 or 7 times, greater than 10%.
So of the 20, six or 7 times, it was a
They've
good
they've
decision.
outperformed 100% of the time.
But then like 13 to 14 times, they weren't a good choice.
So I think what would be a better
Out of
analysis is if
20.
we go back, that long, instead of we're just kind of guessing and spitballing here, is show us the longer term compared to the indexes.
Yeah, we can run some analysis on the composite.
think-
And let's do that again, because we'd have these conversations back to 2021.
I was gonna say,
They
since I've been
underperformed in
here,
21.
I've not heard a good year. And I granted, it's only been 3 years, but since 21, 22, 23, now 24, but they've been on the radar and we're looking at them and they may be something for
Yeah, but
consistently
why
since
don't
we've
we'll
been
bring
on
in
here.
some just longer term analysis to digest a little bit.
That would help, thank you.
And if the committee wants to make the decision to move on and just move it to passive, it's your prerogative, absolutely.
Well, one, I think we have, the passive, active conversation, and it's not just a Clarkston
Right.
conversation, it's do we have passive and active together, which I'm a big believer of, but that's just me personally, I'm not saying, but as a committee, we should make sure we're on the same page, and then is that the right fund manager in the space for active? Because, Microsoft was down 10% last week in a day. I mean, so now you hold the
Yeah,
index.
they missed on their AI.
And they had the
expectation
crowdsource.
and cost.
In one day, we don't want to be part of all in on something that can move 10%, in my opinion.
Yeah, and that's
So
a
that's why we have-
13% weight in the Russell 1000 growth.
Right, so that's why we have the diversification, so we're not getting hit at one time with, growth is everybody's baby right now, right? And so I just want
Which
to make
means
sure
it
we're-
won't be
I-
for much longer.
It usually
Because
will.
everyone
Yeah.
now
Right.
shoving all their money, all the chips on the table are going into large cap growth.
And I do agree with that, just are they the best?
I'm
That's
good with
my
that. I'm
only
good with that
question.
question, sure.
Yeah.
I mean, it's good to have the active, passive
Yeah.
conversation along with it, but, yeah. So we agree that we're going to look at that a little longer term?
Yeah, we'll do the same thing. I think we did at the beginning of 2022, after those discussions on 2021 underperformance. We just looked at the long-term track record. How did they do, outperform, underperform?
That's for Clarkston or for?
I think both. I think they warrant, there's enough questions
Edgewood
from
and
the
Clarkston.
committee
Okay.
for Edgewood and Clarkston to have a little bit broader discussion. I think there was some comfort level also when we did hear from the partners at Clarkston and from Edgewood. And if you don't like what they say, then we gotta move on. But hearing from them rather than just Brian and I droning on about what we think about these managers, but we know them well, not too well that our judgment would ever be.
And I did not
blo-
mean
no,
that
no, no, no.
offensively.
I know exactly what you
absolutely
mean.
not.
We've
It
known
just
them
meant
for
like
15
you
plus
trust,
years.
You trust that they know what they're doing, but have they, maybe their newer manager isn't the best, and maybe there's another that's, I did not mean that offensively.
We've taken them to task plenty of times. In fact, I did a call with Jeff Hackala on Monday, and then I called the client service representative Tuesday afternoon. And I said, that was one of the worst calls I've ever done with Jeff. He was all over the place talking about his individual stocks. He didn't sit down and talk through the investment thesis on these stocks and what has worked and what hasn't worked. So I made them, for the rest of the day, they had to go through and do a complete brand-new exercise for the last 18 months on the worst 5 underperformers. I wanted to know what industry they're in, why they bought it, what's the investment thesis, what has worked and what hasn't worked. So we put their young associates through a lot of extra work on Tuesday to get that to Brian and I. The next page shows your international exposure. We talked about this in RHC as well. As much as we talked about the disappointing returns from Edgewood and Clarkston, Brian and I are ready, and I know Brian and Michael Shostak have had this conversation on Oakmark. Because of their deep value nature, They've been more of a consistent underperformer than even Clarkson and Edgewood have. And we think a search is warranted here to look at potential replacement candidates. We already have the index fund in there, so it's a good complement, 50% exposure to each. So we'd like to present a search book to talk about potential candidates on Oakmark. JP Morgan on the emerging market side, their growth side of the portfolio has certainly hurt them a little bit more. And then you see some of the initial allocations to TerraCap 5 on real estate and principal. I don't know if Ryan had talked about this in the last couple quarters or not with TerraCap, but you see a one-year number. They've had a practice of not marking the portfolio appraising. Typically, a real estate manager, in my opinion, should be appraising 25% of your portfolio every single quarter. Independent third-party appraiser. They had traditionally done it once a year. Some managers do, some managers don't. And so at year end, their valuation committee had all their appraisals from kind of end of the third quarter, beginning of the fourth quarter, and they had to take markdowns on the portfolio to kind of catch up to the rest of the industry. So do we think this is going to be a long-term negative return out of the portfolio? No. In fact, we've re-underwritten every single asset class and then compared it to, we made them go back and re-underwrite as if it's a brand new investment. What do you think the returns are in today's capital market environment? Because the 10-year treasury is very different than it was when they bought these stocks or bought these these assets in the real estate side, 5 to 7 years ago. It's a low single-digit return as of today. So as we get some assistance over the next 5+ years from the capital markets as rates will come down, are they going to come down meaningfully? Are they going to come down to below 2% on the 10-year treasury? No, that's not happening. Historically, the 10-year treasury trades around 4 to maybe 4.5%. So it will see some mark up in the portfolio over the next 24 months as rates tick back to us. So that number looks as an outlier because of what's gone on in reappraising things coming into their 12/31 valuation.
But they don't have any defaults. I mean, so it's market
No,
to
zero.
market.
Zero.
Okay.
Yeah, I just wanted to clarify for the committee, this is not a cash loss.
That's correct.
This is what they call mark to market, where they say, okay, we think that the appraised value of the properties has gone down, so we're going to lower the value, we're going to write down the books, but when they go back up, when we sell them, we're going to recapture all that value. And they have not been selling at losses.
They have not.
Right.
Nothing in this.
They haven't been selling at losses.
Correct.
They haven't been experiencing any other losses due to
No
natural
defaults,
disasters,
no
no
defaults.
defaults.
No defaults, no buildings being handed back to
Right.
lenders. They've got a bit of a runway over the next 24 months to refinance. And as they've talked about, say those 5 properties that have to be refinanced in the next 24 months, the lenders have actually been generally very positive, assisting them rather than a lot of lenders that, I mean, there is problems in the CMBS exposure world. And a lot of lenders are just either walking away or taking the keys because they can't refinance. That is not the case on these properties.
Right. So we're not increasing our exposure to real estate equity. These are real estate equity funds. We did add a real estate debt fund, which is the Bloomfield Capital Investment, where we'll be investing in debt that's on and collateralized by real estate. And short-term debt at that. So with a declining rate cycle, we think that will be an attractive market, and we should be able to see some good returns there. But we're not going to be investing any more in TerraCap or principal right now. So our investment's in there.
That's correct.
It's churning, as is typical with these type of funds. The cycle is 3, 5, 7 years, and we'll start to see some of that money.
And they have plenty of duration left on the investment timeline for that fund, that these assets will reprice up.
Are we yielding on Terra Capital? Are we getting?
There is a cash flow yield, but it's the investment in a value-add real estate portfolio is more for capital appreciation rather than income.
There is an income component for the principal.
Yes.
That we used to be taking as a PIK, meaning that we're taking it as more equity, so it's basically reinvesting the dividends. I changed that election, so starting next quarter, or this quarter that we're in, we're gonna start getting some cash
Yeah.
every quarter.
So you were in the dividend reinvestment program,
We're now.
and now you're out of the dividend reinvestment.
So
So that
every-
cash flow comes to you, goes into the portfolio,
Yes.
rather than buying
And,
more
and that cash will come into the broader portfolio, and it'll be reinvested in our,
along your target allocation.
correct.
You want to talk about the additional handout?
No, why don't you cover just the allocation slide for a second, and then we
Yes.
can, and that'll lead into the next.
This page fine, Michael?
Yep.
Okay. So, again, this page shows your investment policy constraints. So the gray bar is your minimum allocation allowed versus your maximum allocation allowed per asset class. Vertical black line is your target, and then your triangle you can see is your current allocation. So the addition of alternatives and fixed income alternatives and real estate are now in the portfolio where you can see there's an underweight, right? We're gonna build that out over time. So each quarter might be new strategies talked about. You may not invest every single quarter, but you wanna create some vintage year diversification for some of these private equity, private real estate, private debt strategies. So you don't have all of 2024 exposure by example. And so those will remain underweight. Typically, it's gonna take us 5 years or so to get towards those target, because if you think about it, managers in this space ramp up over time. There's an investment window, and then they start to bring you distributions into the portfolio. And so if you didn't do this on a regular basis by reinvesting into these asset classes, you would always, as your distributions start coming in, you'd always be underweight your target. And so you just continually slowly add to these asset classes. It gets you vintage year diversification is what we call it. So a little bit overweight in the equity side because you're underweight some of the real estate, underweight some of the alternatives. And that'll smooth itself out over the next 3 to 5 years.
Maybe a little quicker than that, but we'll see. Do you want to go to this?
Yes. So there's an additional page that was handed out, hard copy. Brian printed this up, made this last week. So update diversification on the pension system. So on the bottom half of this page, there's a target allocation for real estate at 10%, and there's a 5% allocation to alternatives. That could be private equity, that could be private debt. We just called it alternatives in general, kind of a catch-all. You've made a commitment to Bloomfield Capital 5. Those documents are completed, and so they have not called capital yet, 5C. So that'll round out our real estate allocation. What they do is real estate loans. So they do more bridge loans. As the capital markets, banks have kind of dried up with regard to lending on new real estate projects, the average maturity or duration on their loans are about 12 to 18 months. At pretty nice margins, 12 to 15% yields. And so we've asked them, they have the ability at a very small percentage to lend on non-real estate collateral loans, but we've asked them to come to us in writing every single time they would consider that. And to date, I think in 10 different funds, 8 different funds, there's one investment that is non-real estate collateral. And then also with regard to leverage on the portfolio, again, they do have the ability, their documents contemplate the ability to use leverage in the portfolio. To date, since the inception of the firm, they've never added leverage to any of our institutional funds. So pretty conservative, nice yields for clients. And you know why we like it in an environment like this, they can actually go out and buy, as there more and more stress on banks and commercial mortgage-backed securities in the marketplace, they can start buying distressed notes that are already in the marketplace. So they can buy some things at 60, 65 cents on the dollar that they like, that's an ability for them to make some additional yield in the portfolios along with some capital appreciation. So real estate lending with a shorter duration, 12 to 18 month loans. Total length of that fund is probably in the neighborhood of 5 to 6 years, and then they'll go out and raise a new fund. Second piece being contemplated, these are under consideration: Capital Dynamics, Marathon Distressed, Deer Path, Middle Market. So private equity, private companies, in funds, you're going to have exposure to hundreds and hundreds of different underlying companies through all the different funds that they're going to buy. They'll buy them on the secondaries market. So think Chrysler's pension plan that may have had a large exposure to private equity, and now new treasurer and CFO come in with the mantra, I want more liquidity, less illiquidity. Well, Chrysler may be out in the marketplace selling some of that private equity exposure. Capital Dynamics has been one of the largest players of underwriting those secondary transactions, and so they may offer them 75 cents on the dollar, and if they can get that, they're already in the money, right? So this same fund, another client of mine invested closer to the first close. This is not realistic to keep up going long term, but right now out of the gates for 18 months, they're up 62%. 1.4x multiple on their money. So if they put $100 in, it's worth 140 now. Typically, we're going to expect around 15 to 16% IRRs over the long term, and about 1.5 to 1.7 times X your money. Nice thing about starting your private equity portfolio in the secondaries market is you're going to get great vintage year diversification, because they're looking at things historically, right? We're not looking proactively into the future about what they might invest in. These are already funds and private companies that have been created and invested in for the last 10 years. So you'll get vintage year diversification for the last 5 to 10 years. So you create some great diversification. And we expect that the first capital call could be north of 40%, so your money goes to work pretty quickly. Other considerations: Marathon Distressed. This is their second distressed portfolio. We have a description of each of these. This is a fund summary page that our research team writes up for our search books to give clients a general idea of who they are. Marathon's the last page in that book. So Marathon, private credit company. Their first fund was a 2019-20 vintage. So the opportunity was there because the capital markets seized up post-COVID, but the Fed's actions were so quick to unfreeze, unthaw the capital markets that the opportunity set went away. But in this market, at elevated interest rates, stress on company balance sheets, there's going to be an opportunity where there could be some significant stress on companies, and so they're ready to pounce. Nice thing about this is if the capital markets continue just remain rather benign and okay, there are a certain number of criteria that have to happen. They have to be triggered where things do get worse. Otherwise, they can only call up to 50% of the capital. So you're not just putting money to work regardless of what's going on in the capital markets. If things do sour, they can call greater than 50%, but that's the environment you want them calling capital in, because they can buy equity, they can buy debt, they can restructure, buy debt at such a level that they bankrupt the company, equity gets wiped out, they take control. They've done that. One of their biggest transactions was Hertz. May not think much about Hertz as an equity now, but they made a lot of money in Hertz because they owned the majority of the debt in the capital stack. And so when the company did go bankrupt, they took control, worked them completely through the bankruptcy system, and it's been a great win for them as a distressed lender. So very strong team, very capable team with regard to the sophistication on some of these transactions. That fund because of mark to market on their first fund, we have a handful of clients that are in that. It's about a 9-10% IRR right now, but it's because interest rates have shot up dramatically since 2020, right? So as interest rates starts to tick back down, or if you just look at the value of those loans out to maturity, because they're supposed to mature at par, it's about a 15-16% IRR, which is exactly what we expected out of them. So they're out of their investment window, which is why they're raising Fund 2 now. And then Deer Path, a little bit more conservative. This is direct lending. So think about banks, whether they're in the markets or not in the markets. We think definitely they've slowed down in terms of lending, right? Certainly they've slowed down on real estate lending, direct lending to middle market companies. So as there are fewer banks making loans to companies, private debt companies like Deer Path come in and they fulfill that void. And because there's less liquidity in the marketplace, they get to charge a premium for that. So, this is a fund in terms of lending to middle market companies. We expect internal rate of return out of them about 10 to 13%. So it's kind of an opportunistic private fixed income type portfolio. So if we think about yields maybe in the 3 to 5% range, I think it's even a little lower here because of the annuity contract with the pension system. This will be a nice diversifier on your fixed income side. And it takes some of that equity risk off the table.
I think it really is some good possibilities, but it does raise your volatility, and you could see some as we go forward.
But think about where it's coming from is equity,
Yeah, no,
where it's the most volatile.
I'm not
Yep.
speaking against it, but I think that we're not gonna hit 16% every year.
No.
It's not.
No. Yeah, that's over the life of the fund is the target, is the goal. This one's actually more like 10 to 13% for internal return. Yes, if you compare it to a normal bond portfolio, absolutely more volatility.
Which is not bad, because you have higher returns.
Yep,
It's
be
good
cognizant.
to realize that that's what
It's not a free 10% return when
Right.
bonds are getting you 3, right? Yeah, absolutely. It's a
And
good
they're owned
observation.
75% by Prudential?
Say again?
Are they owned 75% by Prudential?
They were just acquired, yeah. That transaction took place, what year was it?
23.
Yeah. But no changes to the investment team, remains intact, which is why we still think highly of Deer Path. We've underwritten the last handful of their direct lending portfolios. They've been one of the stronger performers. So that's the update on the diversification. One idea is being implemented, others are in consideration.
Yeah, we're moving forward. We've already done the Bloomfield Capital. We're moving forward with the capital dynamics for both the RHC and the pension. We've gone through legal due diligence. I've met with their portfolio managers, along with Brian Green, and like what we've heard, so we're moving forward with those. Marathon, I do like a lot, but that's going to be further down the line. So we're not biting all of these off at once. And then Deer Path again. Deer Path's a great specialty lender, like their staff, like their team, but I put them sort of at the back of the list of these options for what we're looking for. And the goal here, of course, is to diversify our overall portfolio holdings, because we have the ability to take on some illiquidity on the RHC side, because our operating budget pays for the healthcare premiums out of our operating budget. And on the retiree side, we have the GDA, the guaranteed deposit account from Empower, that pays the pensioners. So the portfolios that we're talking about here have no nominal cash flow needs on a month-to-month basis. And that's why we have the ability to take on some of this additional investment to diversify and hopefully grow our returns over the long term.
Any more questions on the pension? No, if you want to move to the defined contribution?
Yeah, the DC plans, we continue to see growth. The employees, of course, are putting money into their 457s. Our 401s are the contributed capital from the township to employees' investment accounts. These are for the employees that are not on the pension or the retiree health care. So they have a 401A for the employer contributions, a 457 for the employee contributions, and a retirement health savings plan that we've created for them to, which acts kind of as an HSA. They can put money away pre-tax to save for real, for medical expenses upon retirement. So we've seen, a little tick up in both quarter over quarter as our employees are putting money away. Again, all we do is give them a menu of investment options to choose from, what they want to invest in. So we've got some target year funds, we've got some direct, large cap, small cap, some of the same kind of names that you might see here. And then the employees meet with Rob Higgins from the Schwartz & Company, and he can advise them on what they want to invest in, if they want to look internationally, small cap, large cap, target year funds, whatever their risk tolerance is, and he can help them with that. So that's all we do on that end, but that's it.
Have we looked at the cost structure lately, if the assets have gone up? Are we looking at any repricing or?
That's a good point. Let's put that on as an agenda item for next time. I'll pull together all the costs that we're paying.
And Rob does that, he usually has a
Yeah.
benchmark and so on, but.
Yeah,
but
I think we're.
the times have grown.
Yeah, I don't think we're quite yet at a level that there's the next benchmark
Okay.
for the defined contribution plans. But we should be looking and one of the points that we made earlier when we were talking about Clarkston is that it's sitting 12% in cash. So why are we paying a management fee to sit 12% in cash? So we could put it in cash. So that's something that we should think about, and I don't think it's in this book, but typically Brian Green prepares a slide that shows our overall rate payments. Total fees by investment.
Yeah, that's in the.
By manager, rather?
It's not in the summary.
It's not in the
book.
summary
It's
book.
included in the more exhaustive quarterly
Okay.
report.
Okay, so I'll send out, there's a thicker book, I guess we saved paper, didn't print that, but for the pension plan that has the fees that we're paying by manager. So we can look at that and decide
Right.
what we want to do.
I was more, and again, I think I've seen those before by manager, which is still good to look at, but I was just making sure that if we've grown assets on these other plans,
Yeah.
that.
Yeah, we should definitely revisit, we should definitely revisit that.
Any other questions on the defined contribution plans or comments? No? Any new investments? I think we kind of covered that.
kinda covered that.
Okay. Any other questions in general?
When's our next meeting?
Oh, sorry. Next meeting's Thursday, October 31st, 2024 at 8 a.m. Did we just send out a,
Yep.
okay.
We'll send out a calendar invite and of course an agenda as it gets closer.
Thank you. With that, the meeting's adjourned. It is 8:54.
Great.